Today is Tuesday, February 7th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Alan Bush, the Senior Financial Economist at ADMIS, and Steve Freed, Vice President of Grain Research here at ADMIS. Steve, let's start with the grain markets this morning. Since the U.S. election in November, there's been a lot of concern relating to foreign trade. What has been the impact on trade specifically with China and Mexico?
Well, I think right now no one knows exactly what's going to happen, but we've seen in a kind of a different issue that China's put some import tariffs on our DDG and ethanol imports, and that's caused margins to collapse here in the corn ethanol business. We also have seen Mexico talk about retaliation if something happens either in immigration or trade. The first thing is they may not buy our high fructose corn syrup. The second thing, they may not buy our corn. We've kind of seen countries like Australia and Brazil line up to talk to both China and Mexico, possibly, coming in and taking over some of the export share out of the United States. So right now, nothing official, but a lot of people are posturing to try to move into a direction in case there's trade issues.
Staying with China for a minute, now that the New Year holiday is behind them, here in the Year of the Rooster, I believe, is the Chinese demand for soybeans still strong? Are they buying now?
Two things about China. Number one, they are buying. And what's interesting is they're buying from the United States for the April position. A lot of people thought that they would buy from Brazil. In the Brazil situation, logistics might be an issue. We're seeing off and on showers in northern Brazil. They have a record amount of beans sold for the month of February, and so logistically, can they load those boats on time? And then secondly, I think that the Chinese came out with their once-a-year annual report on rural developments, and they left out self-sufficiency. So for the first time, they're talking about reducing corn acres, they're talking about selling corn stocks, and increasing demand. And one of the issues later in the year could be that they may actually start exporting corn.
The crop in general in Brazil and Argentina is good?
We'll find out on February 9th, but Brazil's got a record crop. So unlike last year when the crop started declining, it's actually getting bigger. And Argentina's had too much rain, so their soybean crop is probably getting a little bit smaller. But it's not a game changer.
On the board here in Chicago, corn futures have been trading in a sideways pattern of late. What is your current outlook for corn in 2017?
The funds have no position in corn. They're itching to buy corn because historically it's cheap. The farmer has a lot of corn to sell. I think what's going to be interesting is in the next 2 weeks, our weather guy is going to put out a new forecast for the U.S. 2017 summer. Earlier he was normal. Now he's leaning for a little bit drier than normal U.S. summer. So I think what you're seeing is a lot of commercials, a lot of end users starting to buy corn just in case it goes up in 2017.
Alan, let's shift over to financials for a minute. Last Friday, it was reported that the January non-farm payrolls increased by 227,000, quite a bit above the expectation of 180,000. What does this mean in the mind of the Fed? Does it change the probability of another rate hike in May or June?
Well, normally it would with those numbers being as good as they were, but one thing that was not quite as exciting was the hourly earnings number that actually came in only up 0.12%. That compares to the estimate of up 0.3%. So the earnings were really not that good, and that offset the better than expected employment numbers. So our feeling is that the Fed is still on track to raise rates only 2 times this year. Probably not at the March meeting, which only has a 9% probability of a rate increase. I would think the June meeting is the most likely time for the Fed to raise, and probably again at the December meeting.
Looking at the U.S. dollar, the chart suggests that the greenback may have topped, despite the fact that the U.S. is the only major central bank on track to increase rates this year. What are your thoughts on this?
I do feel that the dollar has topped, and even though the Fed is remaining very hawkish, likely to raise, the Trump administration apparently is not interested in a strong dollar policy. In fact, President Trump made comments basically saying just that. So this, in effect, reverses a at least a 2-decade-old policy of a strong dollar policy. So we feel that the dollar has topped, even though the Fed is likely to remain aggressive and hawkish. So any rallies that we see in the dollar index should be viewed as selling opportunities.
Finally, Alan, it appears that geopolitical risks to stock index futures have increased. Why has the stock indexes held up so well, and has this changed your bullish outlook at all?
Well, first of all, the rule of thumb is that anytime a market ignores bearish news and continues to advance, that has to be viewed as a sign of strength. Also today we did have the Dow and Nasdaq futures advancing to new historical highs. So even though there are some geopolitical risks on the horizon, stock indices continue to march higher, suggesting that just in itself to advance to these new levels, new high levels, suggests there will be follow through. The Fed is still, even with rate increases, likely to not raise rates high enough to actually reverse this bull market. So look for more of the same, further gains in the indices. I think this is a trend that will last for many months. So continue to trade stock index futures from the long side.
Let me flip back 1 minute into the grain market. Steve, in your opinion, has the importance of sound risk management increased for the farmer due to the prospect of continued abundant supplies of grain, both here in the U.S. and abroad?
I think the answer would be yes. I think the farmers' net farm income is coming down, and so they have to hedge their risk. And they've sold most of their beans from last year. Now they are looking ahead for 17. Sell the cash and buy a call. It's as simple as that. As far as corn, they own a lot of corn. The market is low enough they can't buy puts, but on any rally, let's say of 10 or 15 cents, he should sell the cash and replace it with a call. Then he's done with his marketing. And so he has to use marketing this year to try to bring in more income when his income is down.
If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or open a trading account, please visit www.admis.com. Remember, the views and opinions expressed here today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company.